have observed in 2025 an inflection point. The tokenized asset reached a market cap of $21 billion EOY.
When you see the convergence of regulation, technology, market participant, the demands, you actually have something that is quite transformative in the market.
Payments 3.0 is the era that we're now entering that's being enabled by blockchain and by stablecoins. Once you agree on some sort of a standard, you have this direct connection where you have kind of at most two counterparties involved in every single transfer.
So the volume of stablecoins between 33 and 46 trillion in total transaction volume per year, the double of what we have seen last year.
Charles, what is the biggest risk for banking institutions not moving on the chain?
I think with the development, especially of 24/7 markets and of instant settlements, how you can still be competitive.
How do you see Coinbase, Kraken, those guys are getting licenses? Do you see them as a threat for the future?
Oh yeah, definitely.
Welcome to the fourth episode of the podcast by Audactus, exploring innovative accelerators, transformation journeys, and leadership tales across the financial services. After three first episodes with Stéphane Public, Xavier Volatier, and Chimista Lizarazu, we are now inaugurating a new format alongside my co-host Patrick, and today we'll explore digital asset, tokenization, and blockchain adoption by the traditional finance. So we are very delighted to host three speakers representing the institution engaged in this tokenization space. So we start with one traditional capital market institution. We have one representing infrastructure and dedicated to post-trade and repository in Europe and across the world, and a fintech offering cross-border payment on the chain. So gentlemen, I'll let you briefly introduce yourself, your role, and your companies.
So hi, I'm Jorgen Ouaknine. I'm the Global Head of Innovation and Digital Asset at Euroclear. Euroclear is a global financial market infrastructure. We're headquartered in Brussels, Europe, and we have a global reach. In terms of scale, I think it's going to be important when we go deeper into discussion. We have more than 40 trillion of euro of assets under custody, and we process every month the equivalent of the world GDP. And we're quite active in the space of digital assets, and we'll go deeper into that later on.
Hi, I'm Kevin Lehtiniitty, the CEO of Borderless.xyz. About a year and a half ago, we created the category of stablecoin payments networks, which fundamentally is not another blockchain or not another stablecoin, but rather a connectivity layer to unite all of the fragmentation that exists in stablecoin liquidity and stablecoin payments. So traditionally, if you want to operate in a broad set of geographies, you would need to go and you would need to integrate with a counterparty in every single geography in which you want to operate. This is obviously not sustainable in traditional payments or traditional finance. This is why we have networks like SWIFT, VisaNet, et cetera, so that you can connect once and be able to transact across any counterparty on the network globally. We've done the same on stablecoins. So we're now live in 95 countries, 63 currencies, and we power a lot of PSPs, fintechs, and financial institutions that are using stablecoins to move money cross-border.
Hi everyone, I'm Charles Michallet. I lead digital assets initiatives in the US for Societe Generale. So we are a French bank with a worldwide presence. We have traditional businesses, retail in Europe, capital markets globally, and insurance. We've launched several digital assets initiatives for a few years now, starting with tokenized bonds issued on chain, on public blockchain, which was probably one of the key differentiators comparing to other financial institutions. And we've now launched our own stablecoins, Euro and USD, through SG Forge, which is our dedicated digital assets infrastructure within the SG.
So hi, I am Patrick Bucquet. I have spent the last 20 years or so as a consultant, helping financial institutions to basically bridge the gap between technology and business. Of course, blockchain, digital assets have both been a huge topic for a discussion with these guys.
And I'm Olivier Priou, so the founding partner of Audactus, a New York-based consulting firm, and we support transformation for banking institution here in New York. So as a brief introduction, so today's topic is the subject of a white paper we did and we produced with the Audactus team. So we'll share some of the key insight and finding throughout the conversation and the discussion, supported by a curated slide and more details to come at the end. So blockchain and digital asset might be a bit obscure to some of our listeners. So I'm going to start with a taxonomy of what we call digital assets. So first of all, we have the digital currencies. So they are broken down in 3 subgroups. We have the stablecoin. Stablecoin are pegged by fiat currency or short-term, very high liquid asset. We have the CBDCs, so they are typically standing for central bank digital currencies. So it's a native representation of the money on the chain. And then we have the tokenized deposits, that are typically the representation still on the chain of customer deposit, and it stays in the bank balance sheet, which make a big difference. So we deep dive those differences later in the podcast. Then come the tokenized RWA, standing for real-world assets. So basically, again, the representation on-chain of financial securities. So we find the private equity, private credit, private public equity, of course, bonds, so on, and other assets like the real estate. Follow, of course, the cryptocurrency, so the foundation of the recent blockchain technology historical expansion. Of course, it's composed of the Bitcoin, it's composed of the Ethereum, Solana, and it's reaching an overall market cap of $2.6 trillion. And then the last one are the NFT, standing for non-fungible digital token on blockchain, and it's representing a proof of ownership of a specific asset. And we saw some big company moving in this business like Meta, but the recent period, that particular market is having some trouble, let's say, and it's after a rushing period in the post-pandemic.
Now, if we look at how this digital asset ecosystem is organized, we already see a convergence between new assets and traditional finance. So basically, the way we see it is like a 2-layer infrastructure. So on the first one, we have like 4 critical functions, I would say. So issuance of assets. This is where basically tokens are created and distributed, created/minted. So with players like Circle and Securitize. Then we have the custodians who are basically managing the wallets and the owning of the assets. So we have new players coming from traditional finance, such as BNY Mellon, but also Fireblocks, which is a new company. We have market makers who are providing liquidity, such as jump trading, for instance. And last category, very important, compliance providers, which are focusing for now on anti-money laundering and sanction screening, such as Generale. So we have this first layer, and then on top of that, we have 4 functions which are supporting the core business in line with what we are seeing in traditional finance. So first, capital market. So we are seeing centralized exchange or decentralized exchange, centralized like Binance or Coinbase, and decentralized such as Uniswap. Then we have the financing part, mostly using DeFi, decentralized finance, with protocols such as Aave and Morpho. Then we have the transaction banking and for FX with cross-border payment like Ripple and Borderless, and we will have the opportunity to deep dive with you, Kevin, on that. And the last part is trade finance. This has probably been the first category actually where blockchain came into play. We had, I would say, long time initiative around Conto and Comgo. I say long time in this world, even though it's like maybe a couple of years, but still one of the first initiatives. Everything is sitting on the actual on-chain infrastructure layer, so it could be a public, private, permissionless blockchain, such as Ethereum and Canton that we will discuss later on as well.
So we are done with this short introduction. So we chose to start with the use cases to make it this conversation even more tangible and practical. So we introduce a creation of emblematic use cases, and like to start with the issuance of the Euro convertible or the USD convertible issued by Societe Generale SG Forge under the MiCA regulation, and it's used to do settlement, borrowing, lending, and collateral management. At some point, we have also the tokenized deposit from Kinexys and JP Morgan, which is a tokenized deposit. It's available on the private chain first, and now on the base network, and it's used also for the GPM clients to do payment, settlement, and collateral management. Then comes the BUIDL from BlackRock, which is a representation of shares of MMF still on the chain. Then comes also, you mentioned it already, the issuance of the end-to-end digital bonds issued by Societe Generale on the Canton network, right, Charles, in New York. We also find commercial real estate issuance from Red Swan CRE. Euroclear, we will deep dive it, but you have many different projects, and one is with Banque de France to promote the settlement of tokenized assets with wholesale CBDC. And then the TCC has a similar also initiative with Composer X on that side of the Atlantic Ocean. So, Jorgen, I'd like to ask you this first question. We usually consider this tokenization adoption through tokenized assets, which somewhat looks a bit reductive. So from an comprehensive infrastructure standpoint, what are the key transformations to occur and the use case?
So thanks very much for the question. And I like to take a step back coming from the intro, because there's a lot of terminology, a lot of taxonomy, and somehow we like to simplify it a little bit from a market infrastructure point of view. I think we're at the moment, especially if you look at Euroclear, where we sit at the intersection of trust, scale, and global markets. And what we're trying to do here is not just digitize existing processes, but rather redefine how all this how global markets works at institutional scale. And I think that institutional scale is super important. And we are not a fintech trying to disrupt the system. We are somehow part of the system that makes it work today. And part of the responsibility we have is basically to make a translation of this innovation and this digital asset specifically into something that is safe, that is scalable, and usable by our clients who happen to be the largest financial institution globally. And so obviously we need to have a focus on use cases. That's very important. But if you look at the bigger picture, there's a bigger transformation happening there, and how do we tackle with this transformation? And I think it's important because the narrative has changed quite a lot with our colleagues from the fintech world. If at the beginning it was all about disruption, and then, sometimes later it was all about conversion. And finally, it's about partnerships. And we believe that collaboration beats competition. And that's super important. And the way we see that, we recognize the agility, the innovation that the fintech world can bring, together with the scale and the regulatory compliance and the robustness that we bring and that the client expects from us. So basically, the challenge for us is going to create this market infrastructure that is going to be able to provide a seamless experience between the existing markets, which are huge compared in terms of volume compared to the digital assets, and making sure there's real integration rather than a replacement.
Yeah. So maybe if we deep dive regarding if the main changes when the securities move on the chain, what are the changes in terms of settlement and collateral for CSD like Euroclear?
So we need to look at it from an end-to-end perspective. And there needs to be some consistency end-to-end, from issuance to settlement to custody, and making sure everything is interoperable. And when we started our journey with DFMI, we did issuance of tokenized bonds. But we wanted to solve a specific problem. The specific challenge we wanted to have in mind is, first of all, demonstrate that we could do that being fully regulated, and that regulation was rather an enabler than a challenge. And we see how regulation has evolved, allowing even for more innovation. and as well the liquidity issue. So most of the bonds that were issued before were somehow sitting idle on a public blockchain waiting for redemption. And what we have created with this platform, and you can see this impact here, is that you have all the first primary market distribution that happens on chain. And because there was not enough supply for all the buy side to be able to move directly, we created a digital twin so you can have all these digital assets directly on the collateral highway, benefiting from all the secondary market liquidity almost near real time. And that has proven to be quite efficient because that not only inspired some of our colleagues to adopt the model, but we have part of the most liquid bonds and most distributed bonds, and some of them we even have to issue them because, to meet the demand. So, it's important to start from a point where you have regulatory clarity, you have technological readiness, and you have client demand, because otherwise it remains at an experimentation level. And now we basically see that the narrative has changed from early days, we want to know what this can do, to today we want to actually future-proof our business, leveraging the platforms.
So Charles, we mentioned a couple of use cases already and previously. So what kind of new use case or extension of existing use case you are considering to keep improving the efficiency at Societe Generale CIB?
Yes, to Jorgen's point, I think it's really critical now that we see these key infrastructures coming on chain and enabling this kind of network effect that we haven't seen so far. We've done a few issuances on chain, and it was always requiring bilateral connections with the participants of the transaction. So because you have KYC compliance requirements, you need to have this knowledge of who owns the securities at every time, because if you need to pay them a coupon or the redemption, well, obviously you need to know who you're sending the money to. The other thing is that the issuance of securities is quite complex. You have various participants, you have the paying agent, you have the infrastructures, you have the registrar, etc. And I think at the beginning, the idea was, well, with blockchain, we will be able to remove most of these layers. They are just doing like administrative work that blockchain will replace from day one. And what we see is that it doesn't really work like that. You still need to do tax to withhold tax when you do payments, and this is the kind of administrative process that usually issuers don't want to do by themselves. So that's why you have paying agent or custodians to do it. And so all these initiatives were pretty limited in terms of liquidity, and that's why we haven't seen a huge demand in terms of institutional adoption. So it can work very well for some very specific use case. I think you mentioned BlackRock's Beetle. Pretty good success, pretty large asset under management. But other platforms are pretty restricted in terms of circulation of the tokenized assets. Everyone needs to be onboarded first, so you don't really have this kind of liquidity effect that because the asset is on chain, it's automatically transferable. That's not really true. Obviously, that's for securities. Crypto is a different story. And so that's why what we see today with the current initiatives from Euroclear, from DTCC in the US, which has been pretty vocal on these topics as well, we see a growing demand and adoption and initiatives from institutional actors to participate in this ecosystem, because they know that once they're connected, they will access basically the whole market or tap into the liquidity of all the participants. And I think that's what we will see in this probably in the next few months, the POC, the pilot trays, making sure everything works, the plumbing, and then in a few years' terms, hopefully a full transition.
Okay, so Kevin, how could you walk us how Borderless.xyz address this cross-border and FX payment on the chain?
Yeah, I think if we look at the history of payments really quickly, we can define it into kind of three buckets. And for me, payments, maybe 1.0, is the original correspondent banking model that's been around since the beginning of banking, right? And we all know that SWIFT messages are instantaneous, but unfortunately the clearing, the correspondent banks that are involved in the chain, the compliance processes, things like that, are certainly not instant, right? And I think it's less than 10% of the world's banks are actually part of the SWIFT network, which leaves 90% of banks outside of that and using the correspondence in order to move funds. And this is especially painful in emerging markets, Latin America, Africa, Southeast Asia, et cetera. And that kind of gave rise to what I think of as payments 2.0, which is the rise of fintechs, right? This slow and kind of inefficient settlement model created opportunities for wildly successful companies. Think AirWallex, think Neum, think these sorts of companies to create the illusion of instantaneous cross-border payments, right? Mechanically, nothing's changed in the infrastructure, but now they're pre-funding balances, they're managing these kind of treasury programs or things like that, so they can take money into one pocket and then send it out of the other pocket, and now all of a sudden we have instant payments. But in the background, they're still rebalancing all these treasury operations through traditional correspondent bank transfers and all those sorts of things. Payments 3.0 is the era that we're now entering that's being enabled by blockchain and by stablecoins. And this is not a new user interface on top of correspondent banking. This is now the fundamental rewiring of the underlying infrastructure. And what's interesting about using blockchain-based settlement mechanisms is that once you agree on some sort of a standard, right? Let's just say it's USDC on some sort of a chain, right? And you can support many standards. Most people support multi-chains. Most people support multi-token. Now all of a sudden you have a complete graph. Meaning if I can ingest stablecoin in and send fiat out, and you can ingest stablecoin in and send fiat out, we can now settle directly with each other. We don't need another correspondent banking layer. We can do this as fintechs. We can do this as PSPs. We can do this as financial institutions, right? And now you have this direct connection where you have kind of at most two counterparties involved in every single transfer, and you're guaranteed to have at most two counterparties, right? And in many transfers, you think of US to Euro, things of that nature, you already have two counterparties, right? So it's not necessarily an optimization on that. But when we think of remitting cross-border funds from Latin America to Asia or from Africa to Southeast Asia or something like that, you don't have these direct connections, and that's kind of what the stablecoin world is enabling. So that's a lot of the use cases that we see are predominantly around, I think, one is treasury management. And it's treasury management from large multinational corporates who operate in a lot of emerging markets. And because of either the FX risks or the costs of hedging against those FX risks, the ability to deploy capital in near real time into those subsidiaries and the ability to repatriate funds back in near real time presents a significant cost advantage to having to hold local currencies at scale, having to hedge against those FX risks, things like that. The other thing that we see a lot of is in the B2B payments world, it's primarily trade. So import, export, things like that, where DVP is actually kind of interesting from a payments perspective because you have a large cargo ship that comes from China, which is the world's factory, right? And it goes and it arrives itself into Africa. And the cost today of sending a stablecoin-based remittance from Africa to China from an FX standpoint is actually more expensive than it has been traditionally, right? There's an FX price premium to stablecoins. But what happens is you have a counterparty in China that doesn't want to release the cargo until payment's been received, and you have a counterparty in Africa that doesn't want to send payment until the cargo ship arrives at the port, right? Which is fundamentally logical. It's a pretty standard DVP issue. And with a traditional correspondent bank transfer, it may be 3 to 4 days to settle from Africa ultimately into China. And now you have a cargo ship sitting at port for 3 to 4 days. So this is no longer an FX fee optimization problem. This is if I can now settle T0 instead of T plus 4, sure, I'll pay an additional 10 basis points on that transfer because those 10 basis points are far cheaper than paying 4 days of port fees for this cargo ship to sit there waiting for payment to be received to then go and offload things. So these are maybe more niche use cases, especially when we think about the scale at which Euroclear operates or the scale at which SocGen operates. But these are like the very real optimizations that we're starting to see with stablecoins. And I believe this is going to continue as the infrastructure matures and as more established players enter the space, it's only going to continue to increase. But these are the niches that are acting as kind of the footholds for stablecoin payments to gain adoption today.
So maybe just to add on the list of use case we just mentioned, I have a couple of one that pop in mind that I really find interesting. It's the first one is Fairmint, which is issue digital private equity token on-chain while managing the cap table, which is an issue for entrepreneurs. So it solves a very large concern. And then the second one is LIS, which is the first market stock exchange allowing players to go public and again natively on-chain. And we had the first example a couple of weeks ago.
Yeah, and maybe just to elaborate on what you were saying, we need regulatory clarity, that's for sure. You mentioned as well that liquidity is not that obvious because you still need to onboard the other counterparties. KYC is still very important. So I think one use case that is illustrated by chain analysis that I mentioned earlier is really this compliance, let's say, requirement from traditional finance pushed or used, let's say, to digital assets management. And so chain analysis, managing the KYC, the AML sanction screening is really an example of, okay, it's not like a regulatory loophole. Digital assets are really under full scrutiny, and compliance is becoming like what will support the development of digital assets, and that will take them mainstream.
Okay, so we closed this part on use case. Let's talk about institutional readiness. Market shift. So we have observed in 2025 an inflection point as the tokenized asset reached a market cap of $21 billion US dollar EOY versus 6 billion in 2024 and 2 billion in 2023. So it's still very negligible, let's say, when compared to RWA gross issuance over the same period. But the accelerations at some point reflects the institutional and the crypto native engagement, and to some extent also maybe to key blocker that are steadily cleared. So that's about my first question, Jorgen. What has changed in regulation, infrastructure, and market landscape to unlock this adoption today?
I think we need to look at it again. Always like to take a helicopter view on this topic because things will only work when they are coordinated and in sync around. And we have to think about it as global markets. And definitely what has happened in the US and what's happening in Europe and in other geographies, are accelerating at different paths. And it's really interesting. And you see, for example, now all the discussion around the DLT pilot regime in France is having the headlines. And it's pushing the market forwards, and we have the regulators that are quite more active. And to take an example about scale and market practice together, supported by regulation, I think the project we're having with Banque de France called Pythagore is a strong landmark project. And what is great about this project is, first of all, it's addressing a huge asset class called the new CP. It's the biggest short-term capital debt market, more than 300 billion. And we have the ambition to tokenize 100% of this asset class together with the ecosystem. And the feedback we are receiving so far is quite overwhelmingly positive because you have more than 50% of the outstanding amount of end participants that are actively engaged in this project. So you have the regulator on one side, you have the ecosystem on the other side, you have the infrastructure providing all that, together with, and it's going to settle against CBDC, leveraging the bond test from the European Central Bank. So when you see the convergence of regulation, technology, market participant, the demands, and actually scale, because it's the full asset class that has a lot of volume and recurring volume because the maturity is from 1 day to 1 year, you actually have something that is quite transformative in the market. But again, we see that Europe is very much focused on CBDC. We see that in the US it's more about stablecoin. We need to get somehow a form of alignment. But at Euroclear, we do already central bank money, we do commercial bank money, we do tokenized deposits. We have done the ECB trials with CBDC, and hopefully soon as well stablecoin for what is allowed. So it's progressing, and we are leveraging the different means and regulated means that are available to basically support the transformation of the market.
And maybe one additional question regarding, the topic of the privacy and confidentiality. Of course, a concern for many institutional. Is it solved now? We have the permission network like the content network or the zero knowledge proof technology or solution that are used on the public blockchain, from your point of view?
So that's a personal view, and I think technology is moving fast, and there are basically two different concepts that are here. And full disclosure, I'm the co-chairman of the Canton Foundation, and when you look at what they have built, they're the only one that took privacy by design natively together with interoperability in the way they built their system. You have other networks that are leveraging other kind of solution, but there are things that capital markets cannot compromise on. Privacy is part of that, and that's very important. So all these solutions that exist today have a lot of value. There's not going to be one network that is going to rule them all, but there are networks that are better fit for some use cases, some purposes. And the most important thing is going to have this global interoperability between them. So that's very key. And maybe just to comment on one of the points you mentioned around compliance and risk. We're working currently with the Global Blockchain Business Council on the risk mitigation framework. And I want to insist on that because for me, it's somehow part of the last mile before you can see big adoption. In many institutions, whenever you have a crisis, when you have a problem, you have a very talented team that can, come together. They know the system by heart. They know how it works. They have clear processes on how to solve it, and they will fix the issue. Yep. Now, we have to recognize that when it comes to blockchain, well, there's a novelty part of it. There are new risks that didn't exist before that are linked to the blockchain risk that need to be embedded in our processes, in the way we work. There are existing risks that need to be as well adapted. And there are things that will never change. Compliance, KYC, AML, sanctions, that's part of it. So maybe the easiest part, to be a bit caricatural, is to put the assets on chain. How do you make that work at institutional grade, and how do you transform in depth the institution from processes, legal framework, operational readiness, and interconnectivity, and all this industry synchronization and coordination? That's part of the key challenges we want to solve as well.
Yeah, and to continue on that front, Jorgen, I think the regulation clarity, again, is a key point to make sure that we manage better risk and compliance, of course. So what we are seeing, and it's pretty good news actually, that regulators are really pushy in that direction. So we have seen that in the US with the Genius Act, which is providing clarity, at least for payment stablecoin clarity, and then the Clarity Act might provide less clarity, but we'll see that. And in Europe, we have MiCA, which is now fully in effect. And this is very good because it's providing an harmonized framework first. Secondly, a known framework for every institution. And the last part I would like to mention on regulation is that also crypto-native firms are now getting licenses, right? So we have seen that in the US. So it could be fully approval or conditional approval with BitGo, Circle, Kraken, and Ripple. And so these crypto-native firms are becoming closer and closer to become also, like I would say, traditional financial firms.
So Charles, SG has always been at the forefront of tokenization and digital currencies adoption. Can you tell us how has the perception from your senior management evolved along the recent years, and what is cooking now in 2026 and for 2027?
Yeah, I think, as you can imagine, for a bank like SocGen, we had the senior management support from the start. Otherwise, we would have been able to develop this project and to launch these products as early as we did compared to I would say the rest of the market, especially on public blockchains. Again, it's probably one of the key differentiator. And maybe to a point in terms of regulation, we've been fortunate enough in Europe, and in particular in France, to have a very clear framework, at least for securities and using blockchain to register securities ownership. That has been in French law for quite some time, and that's how we've been able to issue our first products by using Ethereum to register the ownership and by representing the debt as tokens on Ethereum. Then we've had MiCA, obviously, so that helped us with the stablecoin initiative, because the first bonds that we issued were settled through traditional cash, so you can deliver half of the promise of I would say, the blockchain experience, where, okay, you send a token that represents a debt, but you still need to settle through traditional rates, because 5-6 years ago, very few people, at least from the institutional world, would touch stablecoins. There was no regulation, no transparency on the reserves. Some of them went down pretty harshly at the time. And so we couldn't really find a solution to settle these transactions on chain. And that's what also kind of pushed us to launch our own stablecoins, having the view of, well, we are a reputable institution and having like an approach that our clients understand in terms of, minimum rating for the collateral that you will put in to back the stablecoin and things like this will make a lot of sense for institutional adoption. And it's a bit the same in the US. So we tried to replicate what we did in the EU in the US, starting with the bond issuance last year on Canton. And that, again, has been made possible because the regulator approach kind of changed over the last years. We've seen a lot of guidance recently from the SEC for broker-dealers to interact with tokenized securities. And that helps a lot internally in our discussions to get everyone's comfortable in terms of compliance issues. How do you prove that you can use the blockchain to register ownership of the securities under New York law or in the US, generally speaking? What we see now is that the whole market is evolving. As Jorgen said, there will be different platforms, different blockchains, different cash equivalent on chain, whether tokenized deposit, etc. We don't really know who will win. There will be different use cases that will require different types of assets, but we definitely want to be a part of the game. And I think we're pretty well positioned today with Forge and with everything that we've developed to at least to serve a number of these use cases. On the stablecoin front, obviously it's quite different because these assets are freely transferable. So from a compliance and KYC perspective, it kind of was, I would say, a journey, internally speaking, to explain and get the support of the various functions to say, we will issue a product. It can circulate freely worldwide. And I think that the last mile and what we've seen is that we've had support also from regulators in the EU. Forge is regulated by the ACPR for this stablecoin activity, and they've been very supportive. And in the US, we've seen very recently guidance for how to monitor secondary market transactions for stablecoins from FAC and FinCEN. And so this is how probably more people will get comfortable using stablecoin, not just issuing them, but also using them because they will know that it's a safer and safer environment to work with.
So Charles, you mentioned that your senior management is pretty bullish in that space. What about your clients, the corporate and the institutionals? Are they coming up with question requests to benefit from on-chain use cases?
Yeah, it's kind of volatile, like pretty tied to Bitcoin price. But I would say several years ago, it was more like we want to. Our clients were, okay, we want to do some kind of innovation. What can we do together? How does it work? We would like to do blockchain without doing crypto. So let's do securities on chain. That's a safer environment. I think the narrative has changed a lot. Everyone knows they have to do something about this. They don't necessarily know how or when, but not having a hedge on what happens to my business if tokenized assets develop and everything goes onto blockchain or DLTs, it's kind of a risky bet, I guess, to do today, not to hedge against this evolution. And so we are definitely more in a situation where it's not really about POC or one-off trades or buying a bond and keeping it on the balance sheet until it matures, but like, okay, I want a bond, but then can I use it with this trading exchange to repo it or to exchange it on the secondary market? Can I use your stablecoin to buy it? So we did it with AXA, for example. It was like a whole new experience, like DVP, insert a new settlement on chain. And that's the way we see the evolution. So today we have, I would say, 3 markets in terms of adoption. We have the retail market, and actually, I would say most of our growth on the stablecoin business has been driven by retail today in Europe, and partnership that we've done with retail distributors. And we've just announced, for example, the partnership with MetaMask, so that hopefully will also help us. At the other side, we have institutional actors, and we've been pretty busy with them. We've been, doing facilitating repo on tokenized treasuries and things like this for hedge fund clients that are looking at, how to benefit from, availability of the assets 24/7. So we did this repo on the weekends, for example, which is not something that is not usually done. And then we have, I would say, more the corporate world, like the treasuries, the treasury managers of corporates in the world. And that's where we probably will see also a growth in terms of interest. I guess it's not really their first immediate need or, I would say ideal solution to use stablecoin, because it means probably changes in their accounting system, booking systems, processes. And so, when you have tons of stuff to manage, unless you see a real advantage in using stablecoin, it takes a while. But this is definitely the kind of discussions that we have with large corporates these days.
So, thank you, Charles. It's a good transition to the digital currencies and the stablecoin tokenized deposit and CBDC part, which we call the missing cash leg. So the stablecoin has by far the largest market cap. It's reaching $300 billion, while CBDC and tokenized deposit are below two-digit billions dollars. So I won't initiate the debate here, which is the best solution, and
stablecoin,
because it could easily takes hours to discuss about the pros and cons, of course. But the stablecoin are led by Tether, Circle, Paxos, or Ripple overall. And then you mentioned, of course, SG Forge and Euro in France in particular. And then we have the CBDC, and you mentioned the project Pontes and Appia, led by the ECB in Europe, of course. And then the GPM coin and GPMD that are the representation of tokenized deposit. You mentioned already also, Patrick, the MiCA and the Genius. It still raises multiple questions and concerns regarding sovereignty, monetary policy, the interoperability, and we'll deep dive again this part. Do we offer yield or not on the stablecoin? That's a huge debate, and we had an example in Davos recently. Also, the liquidity and capital requirement from a booking standpoint for the bank as well, and to some extent the tax classification, and we'll discuss it also. So all those solutions and the stablecoin in particular are considered now as a payment mean from regulatory perspective, and I would say across the board. So what we need to keep in mind, whatever the solution we use, it brings the missing cash leg. It's most likely the most important part as an accelerator for liquidity management and settlement execution.
Yeah, and just to put everything in perspective, I would say when we look at the numbers, it's quite interesting actually, because looking at the volume of stable coins, it's about, depending on who make the estimation, it's between 33 and 46 trillion in total transaction volume per year, which is basically the double of what we have seen last year. So the trend is pretty good. Again, this is like in comparison exactly more or less at the same level as what we are seeing for card transaction, Visa and MasterCard combined. But it's still quite far from the total, let's say, transaction volume processed by through chips, which is like 10 times this. So it's like 10% of the total volume. But what is important is that the trend is like exploding. So we are in a good pace, I would say. Now, Kevin, I have a question for you. And I think you touched upon a little bit when you were presenting the history of payment. What would you say about digital currency and maybe more specifically stable coins? Why are they becoming the core enabler of on-chain finance?
I think you need trust in the underlying asset. Right. And I think the easiest way to put a currency on chain is to have a token that's fully reserved. Right. And we can talk about where tokenized deposits fit into these things, because I think that's a slightly different picture. But if you think about just kind of like from a first principles basis, the easiest way for me to get someone to believe that this token is worth $1 is to make sure that there's $1 in reserve for every token that exists. Right. That's a fairly simple process. Then the question from there kind of becomes, well, then what's the counterparty risk of the issuer? Right, when you're operating within the traditional banking system, you have the appropriate regulations, you have the appropriate compliance, you have the appropriate insurances, you have kind of the right policies and procedures in place. But when you're operating with a stablecoin, now all of a sudden your counterparty risk shifts from the Fed to Circle, right? And especially pre-IPO, who is this small fintech startup that is Circle? What is the counterparty risk of transacting with their token? You mentioned some of the stablecoins that have spectacularly not succeeded in previous histories because of the reserve management and things like that, right? Which now I think that's a lot of the big unlock that's coming from Genius is we've effectively commoditized the reserve management process of stablecoins, right? By forcing it into cash-to-cash equivalents, by forcing it into qualified custodians. You can't do this algorithmic tokenized financial product anymore that now claims to be a stablecoin but is actually just algorithmic trading. You can't all of a sudden take stablecoin collateral and go buy houses in the Bahamas anymore. It's a shocking concept for the crypto world. And I think that's a lot of what starts to bring a lot more trust into the market. And I still think this counterparty risk is where there's a lot of opportunity for financial institution issuers of stablecoins. So that's where I think like what you guys are doing through Societe is very, very interesting. That's where I would see things like JPM and BOVA and others starting to say, okay, even if the reserve management is fairly commoditized, if you are a major institution, are you going to take counterparty risk on Circle or Tether, or are you going to take counterparty risk on JPM? Right? One of those is, I think, a much more viable path forward than the other. And I think that's kind of where bank-issued stablecoin opportunities exist today.
Quick word on the on-ramp, off-ramp challenges, because, okay, we are discussing about stable coins. As I said, it's like 10% of the total volume. We still have to manage like fiat currency and traditional cash, I would say. And if you can maybe, for the sake of time, mention one challenge
Sure.
and one solution, of course.
Yeah. I think the biggest challenge when we look at most of the flows that we process through our network are either stablecoin and fiat out, fiat and stablecoin out, or fiat and fiat out with a stablecoin settlement. So every flow that we do involves local fiat, right? In whatever country it is and whatever the local payment is. We don't touch cards. It's all local bank rails and APMs. So like Gcash in the Philippines and kind of like these sorts of banking rails. I think the biggest challenge today is the fragmentation of the liquidity that exists within the stablecoin world. So when I think about the traditional fiat FX world, I think about effectively what is like one unified market that's then accessed by all the different participants, right? So like from a US-centric perspective, if I go and trade FX with JPM or if I go and trade FX with BOVA, I'm getting the same liquidity, the same rates, the same. It's just kind of where do I have relationships? If you look at stablecoin liquidity, the books are being built by the on and off ramp providers and the market makers themselves. It's not one unified book that everybody accesses. Everybody's building their own FX liquidity. And we've recently published some research on this because we have now 14 locally regulated institutions in different parts of the world that are part of the Borderless network. And many of them cover the same token currency pairs. So we've published a bunch of research saying, okay, venue A, USDC BRL price is X, venue B, USDC BRL price is Y, venue C, the price is Z. And when we look across not the buy side, sell side spread, but we just look at what is the variance in the FX price from venue A to venue B, in Latin America, it averages 60 basis points. In Africa, it averages 80 basis points. This is insane, right? Whether you pay 100 basis points or 200 basis points, it's a widely different transaction cost, right? And the venue at which you execute your transaction massively has an impact. And this is very different from traditional payments, where the venue that you route through really doesn't have that much of an impact ultimately on the spreads and on what you pay. So I think the answer to this challenge is a lot of what we've been working on, which is if you process your payments through a single PSP or a single provider, you are completely captive to whatever their book and their rates look like. So the best way to be able to start to optimize some of this and actually process at scale is to process with a network of providers and counterparties instead of a single one.
Okay, super interesting. So, Charles, I have a question for you about the, let's say, stable coin versus deposit token.
So you want
token.
to go there?
Yeah, this is a good one. So yeah, so maybe the first question would be if you can see the difference, what kind of differences you see and benefits, let's say, and also deep dive on what kind of banks can we think about would issue deposit tokens? Would it be more like the major banks and then the smaller banks would have to build a consortium? How do you see the market moving forward?
Yeah, so I would say the key difference, at least as it was today, because it's an ever-evolving subject, but deposit tokens are only dedicated to be used by the clients of the issuing institution, so the bank. So that limits a lot, obviously, the use cases. So obviously, when you are a JP Morgan or a Bank of New York, your size makes it very valuable because you have enough clients to make it interesting for them even within your own environment. But definitely for the rest of all the banks, it's probably a much more limited use. We might see this change in the future with kind of clearing systems between tokenized deposits. That's in the works from what we see in the market, and that would be super interesting. Stablecoins will probably be also a part of these kind of clearing systems, and you might see hopefully a kind of platform that will allow exchanges and I would say easy to go from one asset to another, maybe with some spread market makers, etc. Now, the way we see it is that, and from the start, the idea was if we want to benefit from blockchain and everything it provides, we need to have an asset and that can be used and accessed by anyone, subject to compliance requirements, but not KYC requirements. And that means our clients can buy our stablecoin from us, obviously, but then they can use it on crypto exchange, on DeFi, everywhere they want. It also means that when they want to redeem, so off-ramp, to exchange, to get fiat back, they don't necessarily need to have an account with us. We can repay them on their account at any other bank. We don't really care where they bank. Obviously, better if they bank with us. We're still a bank. But that it's not a requirement for them to come to us and ask for redemption, which is pretty different from, obviously, tokenized deposit. And so I think that in several use cases, like institutional use cases, where you will need to see collateral movement, etc., even if the risk profile might be different, I think we touched upon that a bit earlier, you might see a higher interest for the use of stablecoin. For retail clients, today what we see, most of the retail using stablecoin is for crypto trading, for DeFi, to earn yield on Morpho, and things like this. That works well. Yeah. It's still limited to I would say a small range of retail people that are familiar enough or not risk adverse to use these services. We also see a lot of retail providers that make it very easy for people to access. So we think of MetaMask, we think of Deeplock in France. So makes the barrier very low to enter this market and to benefit from everything it has to offer.
Thank you. So maybe we can move to the next topic, which is the integration challenge, actually. Especially for financial institutions. So I feel there are like three main challenges when it comes to integration. The first one, Charles, you mentioned it when you were discussing about clients, actually, but I feel for the banks probably even bigger, more important. It's about the operating model, basically, because on blockchain, it's operating 24/7, it's real time. And so the risk monitoring, the transaction monitoring, the risk management, everything must adapt accordingly, meaning it's new processes, new procedure, and new organization. The second challenge is obviously cybersecurity, and we have seen lots of recent news that are highlighting this, especially around this infrastructure on wallet and private key management and smart contract, of course. So with smart contract, code is becoming the law. It's creating lots of potential breaches for cyber attacks, as we are seeing almost not every day, but let's say every month. And last but not least, and we have touched upon it a lot, it's interoperability, actually. So if you think about, deposit token, you mentioned it, stablecoin, even stablecoins, actually, because you still have to interoperate between stablecoins. You have to interoperate between blockchains, actually, the very low L0, L1 level. And last, also, it's the integration and interoperability between blockchain and core banking systems. Core banking systems, as we all know, are very old legacy system, I would say not usually organized with layer and API, so it might be very difficult and a new way of designing IT infrastructure to connect with blockchain.
So to this point of interoperability you just mentioned, you did a very good paper with Euroclear and Clearstream recently, Jorgen, building the path toward digital asset security interoperability. Where do we stand in 2026 on that particular topic?
So interesting is this paper was made with DTCC, Clearstream, Euroclear, and supported by BCG. So all four institutions, and it's the second paper we do together. The first ambition was basically to set up a framework around digital asset securities control principles. It was important, so we made them simple, 6 of them. You have cyber resilience in there. You have legal and regulatory conformity in there as well. So, and it's applicable for all the activity. And the feedback was very positive from both regulators, financial institution, but as well crypto native company, because basically they're telling, you gave us a roadmap to the real world assets that we want to tokenize. And then we decided to double down on interoperability, because interoperability, again, and you started the intro today by some taxonomy, is not about moving a token from layer A to layer B. That's it goes far beyond that. It's about legal interoperability, operational interoperability. It's about the things that make the asset from ownership to controls to life cycle. And you have the full paper on that, and we're hosting an event at Consensus with DTCC, Clearstream, to explain this and to interact with the clients. We are not there yet in terms of interoperability, and we see interoperability as well as something that connects both the new rails and the existing rails. The traditional system might be old, but it's still working at scale. It processes trillions of operations. If you look at the global markets, not only one institution, you have it works well. You have still a lot of friction. It can make it better, but it's not about replacements. It's about integration. And we need to provide this both rail to make it work in a seamless way. And that's a key component. But indeed, in order to make the tokenized markets global, we need to make them really interoperable, and that's what's going to unlock the value.
Yeah, Kevin, we'd like to hear you on the main challenges you face when it comes to interface your solution, your ecosystem with the banking ecosystem, the integration part, let's say.
When I think of the participants that sit on our network, which we call PFIs, or participating financial institutions, I think we're going to see a large increase in the quality and the capabilities of those institutions. So today, they look a lot like on and off-ramp providers, right? They look a lot like companies like Bitso, like Yellow Card, like Bridge, like BVNK, like kind of these sorts of folks all around the world. And while there's a lot of advantages to working through regulated fintechs versus working directly with the banks, it also means that there's this intermediary layer, which adds a challenge of reliability. It adds sometimes a challenge of depth of liquidity. It adds a challenge of like the capabilities from payments and things of that nature, because effectively you're going from the stablecoin network to some sort of regulated fintech to then ultimately to the bank rails through a bank. What we're starting to see is much more willingness from the banks themselves to directly participate in the stablecoin related transfers. And I think that is going to create a lot more interoperability between the local rails and the stablecoin networks when the banks themselves are the nodes versus a fintech that then goes and connects into a bank that then connects out to the fiat rails. And we're seeing this happen quite a bit in Brazil. We're starting to see this happen in the US. Cross River Bank announced a stablecoin rail product directly in the bank next to ACH and Fedwire and their other payment rails. We're starting to see this in Europe quite a bit, and we're starting to see some of this adoption happening in Africa as well. So I think that intermediary layer is currently a large challenge. We're seeing some pretty good momentum in moving beyond that and having the banks themselves directly participate. And then as terms of kind of like clients of the network, we've recently onboarded the first few banks as clients of Borderless.xyz network, which has kind of been interesting. And the common thread that they all have is they're banks in emerging markets. So they're banks that are not direct SWIFT members. They're banks that do a tremendous amount of emerging market to emerging market remittance. And I think those are the ones that have the most friction from the current system. And those are the ones that are looking to move faster into stablecoin adoption because they have so many more pain points. But for them, it's been a similar challenge to say, okay, but my counterparty is no longer a bank now. My counterparty is some sort of a fintech. Let's say I'm transacting into Yellow Card or into Africa. My counterparty is now Yellow Card as like a fintech or a PSP that's then going to do the local rail delivery versus my counterparty being a bank. From a compliance perspective, how do I think about this? From a risk perspective, how do I think about this? So in our mind, the more and more banks start to directly participate, the better that benefits kind of the network as a whole and all the participants.
And maybe the last question about integration for you, Charles. We saw multiple different strategies when it comes for a bank to go on the chain. What are the resource allocation? How do you grow your capabilities on that matter? We see different strategies. You have SG or JP Morgan, you have your own subsidiary with your dedicated team. And some of those other banks are joining consortium like Kivalis in Europe or Faro. What are the benefits of your particular approach and what are the challenges for the bank?
I mean, the first benefit is that we can decide ourselves what we want to do, and as long as we get the validation from one person on the top of the mountain, it's good for us. Now we've seen a lot of consortia, obviously, in the blockchain world for institutions. R3, I can name a few. I think some of them are still out there, but some of them are no longer here. It's super difficult, honestly, to coordinate between financial institutions without a driving force, either from a public authority, either the Banque de France or the EIB or an ICSD that would drive and that would make sure that everything moves forward like a common goal. I know we'll see Kivalis how it works. Obviously, the idea for us to put this under SG Forge was let's create a center of expertise. Again, working on blockchain. Again, we started on securities because at the time it was the easiest place to start with. Everyone knows that it's comfortable on securities regulation. And then, progressively, we launched a stablecoin. Actually, anecdote, we launched our stablecoin before MiCA in a very sophisticated, structured way. I'm a structurer, so it was like intellectually challenging to develop something that must not be a debt product, not cash, obviously. And we had this whitelist approach at the beginning, just to make sure that from a compliance and KYC perspective, it was fine in the absence of a regulatory framework. Now, obviously, everything has changed. Maybe one thing to add on the, if you want really to benefit from this, I would say global markets and not just in local jurisdictions, we must see some kind of reciprocity between big markets regulations. So we know that, for example, for stablecoin, the whole thing is that you are able to send money worldwide instantaneously, or money-like. If you have different regulations, and that's obviously the case, each country or each zone has its own regulation, but if you need to have local stablecoins under local license to be able to operate, and there is no reciprocity, how will you be able to off-ramp locally if you receive a stablecoin that has been issued in another country and is not regulated locally? So obviously I have in mind the big markets, US, EU, so MiCA, Genius. You will see in Genius some kind of reciprocity possibilities that will require a lot of international coordination, political discussions. We'll see how it goes, but I think for me it's kind of the next thing that needs to happen is kind of how this will work between big financial places in terms of regulation to allow one asset to move from one jurisdiction to another and to allow participants to use them in both jurisdictions without intermediaries in the middle that will swap that like do one for one and create another layer of mess.
Okay, thank you, Charles. Let's look at the future in the crystal ball at some point for this last part. So we've conducted a review through 46 banks, asset managers across Europe and the US. And it appears that 80% of the panel is exposed to the blockchain in a way or another through resource allocation, through deployment of proof of concept or production run initiative like you do at Societe Generale. And then while up to 50 to 70% are mentioning tokenization and blockchain in their strategic plan or initiative for the futures, which is a good sign. Even though the market structure is still highly fragmented for the good reason we mentioned still, we recommend to our clients to adopt a proactive approach that fostering this learning curve and acquire the right expertise, which is pretty hard in this market, and also to provide with continuous market watching as the environment is subject to a fast evolvement. So, Jorgen, with the team, we did some projection of the tokenization market cap in the future. We estimate that we could reach $5 to $7 trillion by 2030, 31. We look like we are neutral in our hypothesis. So, do you find it quite realistic? What is your bet on that?
Yeah, you're totally right to use the word bet. For all of us who have been in the space for some year, I think we have all heard this year is going to be the year that it's going to scale.
Only for the last 10 years.
Only for the last 10 years. So, and this year is going to be the year. So I don't want to make any projection there, but again, I want to put that thing in perspective. Mm-hmm. Because there's a strong need for acceleration. Yep. There's a strong need for adoption. That's very clear. But because you have been talking a lot about how the senior management respond to that, if you put things in perspective, you said that the global market cap of crypto is between 2 to 3 trillion. Euroclear alone has grown their assets under custody by 5 to 6 trillion in the last 4 or 5 years. It shows you that traditional activity is still growing a lot, and we have the time and we have the scale to be able to move in a safe and gradual way that will bring the trust, bring the connectivity, and have the right foundation for this to scale. So I don't know about the exact figures. More than happy to say you're right or you're not. That's a bet. It's not polymarket or calci here, but definitely we see the trend growing.
All right. So, Charles, what is the biggest risk for the institution, the banking institution, not moving on the chain, for now being just an observer?
Can I answer the previous question? More seriously, I think with the development, especially of 24/7 markets and of instantaneous settlements, I don't see how you can still be competitive while relying on the old ways of doing it. I'm not even sure the marketplace will kind of still allow you to do T+1, T+2 settlement when everything moves towards instantaneous settlement. And if you still have a 9 to 5 desk or operation set up and everything happens at midnight because I don't want to get too political, but a war is declared somewhere in the world and the market reacts instantaneously. You need to be able to kind of react along the market in this kind of situations. And that's why it will be gradual, because you won't see everyone's moving towards this, setup instantaneously. We see first, the first movers are usually the most agile. So you will see fintech, you will see very sophisticated hedge funds you will have huge arbitrage opportunities, you will have liquidity dislocation, price discovery. How do you price a treasury during a weekend? TBD, probably interesting research papers to come on these topics. But this will unlock probably a range of opportunities, and with markets that will become even more global. If you can trade like your US versus GPY instantaneously instead of having a couple of days of settlement, the usual arbitrage between GPY and the US, what this will become. So you will probably see a lot of new opportunities, a lot of market changes. Obviously, the first movers will be able to seize them and to identify them sooner than the others. I guess at some point, everyone will need to follow along.
Yeah, and then we talk about the traditional institution. if we're still looking at the strategy and the competitive landscape, how do you see Coinbase, Kraken, those guys are getting licenses? Do you see them as a threat for the future?
Oh yeah, definitely. I mean, that's and that kind of also helps and probably explain why institutions are moving a bit, quicker on these topics. For a pretty long time, traditional banks, I would say, were seeing crypto as something very exotic, very risky, just for retail that wants to, do some fun stuff, bet some money, or very, very sophisticated people. And crypto firms are getting more and more supervised. Obviously, that's what we discussed before. And they are going for additional market share. They are going for growth. And growth is on traditional assets. So they don't want to offer just crypto anymore to their clients. They want to offer money market funds. Like, okay, you've made a good profit on your Bitcoin. Now you want to, go to vacation. You don't want to follow your wallet every other day or every other hour. Well, you can exit, put it in a money market fund, and then when you come back, you can start. They want to offer exposure to S&P 500. They want to offer investment solutions, structured products. And so they are getting the licenses. They are getting the same, broker-dealer licenses, bank, custody, everything. And they will be able to offer the full suite of services. So I think that kind of helps the banks to realize that, well, they still need to protect their cake and their market shares on traditional services as well.
I think this concept of one-stop shop is really key in the move. Kevin, so beyond the obvious operational benefits, what do you say as a strategic narrative when it comes to convince your prospects and clients to move on the chain and for the future?
I think, for us, it's about efficiency of capital. So we focus much less on the scale of the Euroclears of the world, obviously, and we focus more on the fintechs, the PSPs, some smaller financial institutions, some of the corporates. And for them, it's how efficiently can they move money around the world. And stablecoins are showing that, at least on-chain, it's the most efficient way to move money that's ever existed, right? You can move money in a fraction of a second for a fraction of a penny anywhere you want in the world. But the fundamental challenge with stablecoins still today is the interoperability with fiat currencies. So when you're fully on-chain, there's some compliance challenges. There's some fragmentation, which I think is increasing now post-Genius Act. There's 500 new stablecoins that are issued by every single institution. How do you create the interoperability between all these stablecoins? And do you need like a stablecoin clearing layer? And does that just bring back the intermediaries that were previously removed from the system? Like, we can go through a lot of those things. But I think the way that the system exists today, fundamentally, the hard part is not taking a token from one wallet and putting that token in another wallet. Fundamentally, the hard part is making those tokens interoperable with bank accounts, not just in the US, not just in the EU, but in 195 plus countries and all of the local fragmented rails. And what people are really bringing back as positive feedback that are operating on our platform is that there exist in most countries, the US is a little behind here, real-time payment rails. That's what we think about PIX in Brazil. We think about Spain, Mexico. We think about instant SEPA in the EU, et cetera, et cetera, et cetera. But none of these real-time payment methods communicate with each other. So if I have a bank account connected to PIX and you have a bank account connected to instant SEPA, we both have access to an instant payments rail. But these instant payment rails aren't interoperable. So stablecoins providing a real-time bridge between real-time payment mechanisms and bringing this interoperability of the traditional fiat rails, that's, I think, what's starting to drive the most adoption that we see right now.
Okay, so now we can move to the fun format. We have a...
This was great.
Exactly. It was very fun. And then here it's the rapid fire round. So just we have a couple of questions for you guys. You answer with a very quick response. Be brief. So I'll start with you, Jorgen. What is the biggest misconception about digital assets?
Most probably that your crypto exists in your wallet.
Patrick, what one company, bank or fintech to watch?
I really like Morpho because they are building like a lending primitive that is supporting the full financing ecosystem. Plus, they just became a unicorn last week, so it's good to watch them even more.
To all of you guys, public blockchain or private infrastructure, which one will prevail?
Blockchain.
Public.
Public networks always win.
Yeah, public as well.
So one advantage banks still have versus fintech, Charles.
Balance sheet.
And the opposite question, Kevin?
Distribution.
So this podcast come to an end. Thank you all for making it possible, and of course all those valuable insight and conversation we had together. Thank you very much.
It was a pleasure to be here.
Thank you.
Yeah, thank you for having me.
So that was our first podcast by Audactus, a New York-based consulting firm. Before closing this recording, I'd like to say a few words about our newly released white paper about, guess what, tokenized asset, digital currencies. Our ambition is to foster a bridge between traditional finance and the fintech. We're spanning capital market, asset manager, insurer, and hedge funds. This is a really comprehensive study embeds by key concept, definition, and outlook of the market and the ecosystem, at least as of now, a deep dive on the accelerators and roadblocks to the TradFi adoption, and of course a selection of a very valuable use case. In doing so, we had the chance to interview fintechs like Borderless and, of course, incumbents to deepen our own understanding and competitive landscape and their value proposition. We are more than delighted to come and present this work and our finding with our team of seasoned consultants. So if you want to step ahead, if you are an incumbent, a bank, Audactus has developed a dedicated framework playbook to explore and prioritize the strategic initiative, find out the path to success, and of course we can support the integration of those use cases within your financial stack. And for the fintech, Audactus can support the growth and the scale up of the operation and how to interface with the bank standards. So happy to continue this conversation. So thank you for having watched and listened to this podcast. Follow us on our social channels like YouTube, LinkedIn, and Spotify. Thank you. Bye-bye.